I have lived long enough to know that the most dangerous moments in markets rarely arrive when everybody is terrified. They arrive when people still feel clever. They arrive when the headlines still sound reassuring. They arrive when portfolios still look healthy on paper, and the average person, glancing at a statement over coffee, believes he still has time. That is the part I want you to understand first. The late stage of a cycle does not introduce itself with a siren. It introduces itself with normality. A normal trading day, a normal television segment, a normal market close, a normal sentence from an advisor explaining why staying calm is the wise thing to do. Then one morning, the calm is gone, and people discover that what they thought was a temporary wobble was really the floor giving way underneath them. I have seen that movie enough times to respect it. I saw it when speculation outran judgment. I saw it when leverage became fashionable. I saw it when easy money trained people to believe that liquidity was a permanent feature of the world rather than a temporary gift. The crowd always makes the same mistake. It treats the pleasant phase of a cycle as if it were the permanent state of nature. That is how fortunes get built carelessly. That is also how fortunes get cut in half. If I were sitting across from you with your retirement statements, your brokerage account, your cash balances, and the plans you made for the last third of your life, I would not begin by asking what stock could double next year. I would begin somewhere much more important. I would ask whether the structure holding up the market is getting stronger or weaker. That question matters more than the ticker symbols. It matters more than the slogans. It matters more than whatever Wall Street is selling this quarter, because markets can remain elevated for a while even after the structure begins to rot. That is how people get trapped. They look at price and ignore plumbing. They look at momentum and ignore funding. They look at headlines and ignore the mechanism underneath the headlines. When the mechanism breaks, price catches up in a hurry. Most investors have been taught to fear the obvious things. They fear recessions. They fear bad earnings. They fear unemployment moving up. They fear a scary geopolitical event. But the event that does the most damage is often quieter and more mechanical than that. It is a liquidity squeeze. That phrase sounds abstract. So let me make it simple. A market can survive bad news if there is still enough money sloshing around to absorb it. A market can survive disappointment if buyers still have both confidence and cash. A market can survive even mediocre businesses if capital remains cheap and plentiful. But when liquidity starts draining out of the system, weakness that looked manageable becomes fatal. Leverage that looked smart becomes poison. Valuations that looked merely expensive become absurd. The weak spots crack first, then the strain moves outward, and eventually the whole system starts behaving like a crowded theater with too many people trying to reach one small exit. That is the condition I believe thoughtful investors need to respect right now. Not because panic is useful, it is not. Not because certainty is possible, it is not. But because arithmetic still matters, even when public mood would prefer not to hear from it. I have always believed that markets are voting machines in the short run and weighing machines in the long run. People quote that line because it sounds neat. They should pay more attention to what it implies. The voting machine can get carried away for long stretches. It can reward nonsense. It can punish patience. It can make disciplined people look slow and reckless people look brilliant. But eventually, the weighing machine shows up, and when it does, it weighs everything. It weighs debt. It weighs refinancing needs. It weighs valuation against cash flow. It weighs policy credibility. It weighs how much rescue capacity still exists in the system. That last one is especially important. For many years, investors were able to assume that if things broke badly enough, central banks and governments would step in with overwhelming force, rates would fall, liquidity would flood back in, some new rescue acronym would arrive, markets would stabilize. The playbook became familiar enough that people stopped thinking of it as a response and started thinking of it as a law of nature. That was a dangerous habit, because rescue always has a cost. And rescue becomes harder when debt is already gigantic. Interest expense is already swelling, and inflation is not completely asleep. There are moments in financial history when the authorities can respond aggressively and still preserve confidence. There are other moments when every option is ugly. Keep policy tight, and you stress the economy. Ease too aggressively, and you stress the currency and the price level. Borrow more, and you crowd out private activity. Print more, and you dilute trust. That is the trap late debt cycles create. Most people do not notice the trap because markets do not ring a bell when they enter it. They simply become more fragile while still looking expensive. That is where discipline has to do the work emotion is incapable of doing. I want to tell you about a man I once knew through mutual friends. He was not dramatic. He was not reckless. He was the kind of saver the financial industry loves because he made every respectable decision. He contributed regularly. He stayed diversified. He did not speculate in foolish little stories. He owned plenty of stocks, plenty of bonds, a few funds with nice names, and a comforting stack of quarterly statements. He was certain that sensible structure would protect him. What he did not understand was that his structure had been designed for a world in which the old relationships between assets still held up. He assumed the thing called safe would behave like safe when pressure came. He assumed the thing called diversified would offset the thing called risk. He assumed time itself would fix what markets damaged. That confidence, when stress finally moved through the system, he discovered that paper claims can disappoint together. Stocks fell. Bonds did not rescue him the way he had imagined. The losses did not merely reduce his account. They changed his posture. They changed the way he slept. They changed the way he and his wife spoke about the future. Plans became discussions. Discussions became delays. Delays became quiet grief. People talk about market losses as if they are percentages. That is only partly true. Losses are also canceled years. They are also postponed moves. They are also smaller lives. That is why I take portfolio structure seriously. Money is not just a scorecard, it is stored freedom. If the structure holding your freedom is fragile, then your freedom is fragile even while the statement still looks respectable. So what is the actual problem I see? The simplest version is this. The system needs a tremendous amount of funding at the same time that funding conditions are no longer easy. Government debt is enormous. Interest costs are large and getting larger as old obligations roll into newer, more expensive ones. Treasury issuance absorbs capital. Quantitative tightening, when it is active, drains reserves rather than adding them. Foreign buyers do not always behave the way people lazily assume they will. Private markets become more sensitive. Credit becomes more selective. The whole machine starts pulling liquidity out of places investors have grown accustomed to seeing it. That is not a philosophical concern. That is a mechanical concern. When government borrowing soaks up capital and the central bank is not offsetting that drain with fresh liquidity, something has to give. Sometimes the first crack appears in smaller companies. Sometimes it appears in commercial property. Sometimes it appears in regional lenders. Sometimes it shows up in junk credit. The form changes. The logic does not. The weakest balance sheets feel it first. Then the pressure moves into anything that depended on abundant money to justify a foolish price. Then the market begins to discover that liquidity is not an idea. It is a condition. And conditions can deteriorate even while optimism remains on television. If I had to summarize the danger in one sentence, I would put it this way. The market is still acting like capital is abundant, while the system is increasingly behaving as if capital is expensive. That mismatch does not last forever. Now, I do not build my life around forecasting an exact day. Anyone who tells you he can pinpoint the week a turning point will happen is usually selling confidence more than judgment. But I care very much about windows. I care about vulnerability increasing. I care about asymmetry. I care about the cost of being wrong in each direction. If you are modestly defensive and the market levitates a bit longer, the pain is usually tolerable. If you are aggressively exposed and the market drops into a liquidity event, the pain is often permanent. That is what mature capital allocation is supposed to understand. There is a great difference between missing some upside and suffering a crippling drawdown when you no longer have endless time to recover. When I was younger, I could tolerate more waiting. I could tolerate more temporary dislocation because the runway ahead was longer. Most people who watch their retirement years come into view do not have that same luxury. They should stop borrowing the emotional habits of younger investors. Needing the money soon and pretending you have a 20-year recovery window is one of the costliest lies people tell themselves. So if I were rebuilding a portfolio to survive a late cycle defined by tighter liquidity, elevated refinancing stress, and uncertain policy response, I would not begin with aggression. I would begin with resilience, and I would organize that resilience around a handful of buckets that serve very different purposes. First, I would hold a far larger reserve of cash and short-dated treasury instruments than most people currently think is fashionable. This bores people. Good. Boring is underrated when the cycle gets dangerous. Cash is not a heroic long-term compounder. I understand that perfectly well. Left alone for years during inflationary conditions, it loses ground in real terms. But that is only half the truth. The other half is the half people tend to forget when markets have been easy for too long. Cash is optionality. Cash is patience with teeth. Cash is the ability to meet expenses without selling good assets at humiliating prices. Cash is the power to buy when other people are forced to liquidate. People laugh at cash near tops and pray for cash near bottoms. I would rather look a little conservative before stress arrives than suddenly discover, after prices have broken, that I am rich in assets and poor in flexibility. Second, I would own a carefully selected group of businesses with genuine pricing power. Not just popular companies. Not just companies with recent momentum. Businesses with economics that can defend themselves when the environment gets more expensive. That means strong brands, essential demand, conservative balance sheets, durable margins, and the ability to pass along higher costs without watching the customer disappear. Consumer staples can do this. Certain healthcare businesses can do this. Selected energy businesses can do this. Selected utilities and infrastructure platforms can do this. The public likes to treat stocks as if they were one category. They are not. A speculative technology company trading at a huge multiple with flimsy profits is not the same species as a boring business that sells necessities into a loyal market and generates dependable cash. One can collapse the moment financing tightens or sentiment cools. The other may continue collecting cash while investors rediscover the value of stability. In a strained environment, quality stops being a slogan and starts becoming a lifeline. Third, I would own some monetary insurance. People hear that phrase and immediately start arguing about whether a metal produces cash flow that misses the point. Insurance is not supposed to delight you during ordinary times. Insurance is there because ordinary times do not last forever, in periods when confidence in paper promises weakens. Some assets benefit precisely because they do not rest on another person's liability in the same way. I do not need every dollar of my portfolio to be a textbook compounder in every possible environment. I need part of my portfolio to remain useful if policymakers choose the path of debasement, rescue, or credibility damage. An investor who refuses to think in that way is not being pure. He is being narrow. Fourth, I would own selective real assets and businesses tied to the real economy, especially where scarcity, replacement cost, and enduring demand matter productive land, useful property, energy exposure that is actually connected to assets the world still needs. Pieces of the economy that do not disappear because of valuation multiple contracts then. And only then, if a person has both the temperament and the knowledge, I might allow a modest hedging sleeve. Notice I did not say a casino. I did not say hero trades. I did not say turn your retirement into a hedge fund. I said a modest sleeve. Most people do not need to short individual companies. Most should not. But they should understand that reducing exposure is not the only way to defend capital. Sometimes hedges can create breathing room. Sometimes they can make patience easier. Sometimes they can keep fear from forcing the wrong decision at the wrong time. The important thing is not the drama of the instrument. It is whether the structure helps you survive. Now let us talk about signals. People always want one giant headline they can react to. Markets are kinder to those who watch a set of signals. Instead, I would be watching long-term Treasury yields very carefully. If long rates rise materially and hold there, that is not just a line on a chart. It tells you the market is demanding more compensation to finance government obligations. It tells you funding is becoming more expensive. It tells you that the math inside the system is getting heavier, not lighter. Once that happens, interest expense worsens, refinancing pressure worsens, and the policy trade-offs become harsher. I would also be watching regional banks and the institutions closest to commercial property and local credit creation. Why? Because stress often emerges first, where long-duration assets, deposit behavior, and refinancing risk collide. Losses can stay hidden for a while. That is what makes them dangerous. The hidden loss is not the danger by itself. The danger appears when funding pressure forces the hidden loss to become real. Depositors move. Assets get sold. Confidence disappears faster than the spreadsheets expected. Then an isolated issue becomes a broader question about the whole neighborhood. I would also watch credit spreads with far more respect than most television panels ever give them. Credit is honest in a way equities sometimes are not. When spreads widen sharply, the message is clear. Money is becoming more selective. Risk is being repriced. Lenders are less eager. Refinancing becomes harder. Weak companies lose access first, then mediocre ones. And soon enough the market begins rediscovering the difference between a business and a story. That is why I would treat a combination of rising long yields, stress in regional lenders, and widening credit spreads as far more important than whether some large index manages to hover near old highs for a little longer. The index can lie, the plumbing lies less often. Once 2 or 3 of those signals are deteriorating together, I would not wait around for a television host to explain what it means. I would assume the cost of delay is rising. Here is how disciplined positioning would look to me in stages. In the first stage, while the surface still looks calm, but the internal conditions are worsening, I would raise liquidity, trim weak and speculative assets, lighten positions that only work in a low-rate fantasy, and strengthen the portfolio with cash, short-duration instruments, pricing power businesses, and a measured layer of insurance. This stage is psychologically difficult because the crowd may still be making money. Late-cycle speculation can remain lively even after the foundation begins to erode. That is exactly why discipline matters. Prudence rarely receives applause in advance. If the signals intensify, if credit stress spreads, if regional financial institutions wobble, if long rates stay stubbornly high, I would become even more selective. I would not chase. I would not average down into low-quality junk simply because it got cheaper. Bad assets often become cheaper for excellent reasons. At that point, preservation matters more than participation, and then comes the stage most people misunderstand. The opportunity stage. A liquidity event is ugly while you are inside it, but it also creates the best buying conditions disciplined investors ever see. Fine businesses can be offered at foolish prices. Assets everyone wanted at 60 times earnings may be available at 20. High quality can be bought because low quality was forced to sell beside it. That is why the earlier cash reserve is so important. It is not just defensive, it is offensive delayed. If you survive the squeeze with liquidity, you gain the right to buy into the next decade from a position of strength. If you reach the squeeze already fully committed, then every bargain arrives while you are busy protecting yourself from your own earlier optimism. That is the real tragedy of bad late-cycle behavior. It does not merely hurt you on the way down. It robs you of the ability to behave intelligently at the bottom. I have said for years that the stock market is designed to transfer money from the active to the patient. I would add one more sentence here. In dangerous cycles, markets also transfer opportunity from the illiquid to the liquid. That is why I refuse to laugh at cash when the arithmetic is getting ugly. People love to ask whether being early is the same thing as being wrong. No, not necessarily. Being early while preserving flexibility is usually an inconvenience. Being late while highly exposed can be a life-changing mistake. If I hold a larger defensive reserve and markets drift higher for a while, I can live with that. If I stay fully exposed to fragile assets in an increasingly stressed system and then lose 30 or 40% when I actually needed the capital soon, that is not a temporary embarrassment. That is a structural injury. Mature investors learn to compare those two costs. Honestly, one costs ego, the other costs years. I know which one I would rather pay. There is another lesson I want to press on you because I have watched even very intelligent people violate it. Do not marry your portfolio. People fall in love with narratives. They think admitting changed conditions means admitting stupidity. So they hold, they rationalize, they quote slogans that were designed for friendlier markets. They tell themselves they are being steady when they are really just trapped between fear and pride. A portfolio is not a creed, it is a tool. When the facts change, you do not owe yesterday's structure your loyalty. You owe your future self clear judgment. That may mean selling the glamorous position you once bragged about. It may mean reducing concentration. It may mean accepting that some businesses only looked brilliant because money was easy. It may mean tolerating boredom in exchange for survival. That trade is available to every investor. Far too few take it before the market makes the choice for them. I am not interested in theatrical gloom. I am interested in preparation. Preparation is what lets a family keep dignity while others are scrambling. Preparation is what lets a retiree pay the bills without liquidating into a panic. Preparation is what lets you buy excellent assets from stress sellers rather than becoming the stress seller yourself. That is the game. Not being the loudest, not being the cleverest, not catching every last point of upside in an aging cycle. The game is preserving the ability to act. When people lose that ability, they say things like this: I know it is down, but I cannot sell now. I know it is cheap, but I have no cash left. I know this is a good business, but I need to meet expenses. I know I should have reduced risk sooner. Those are the sentences of somebody who surrendered flexibility before the storm arrived. I do not want that for you. I would rather you look slightly too careful today than feel completely helpless later. Take an afternoon and perform the kind of audit people are always too busy to do until it becomes urgent. Open every account. Look at every position. Ask what job it does. Does it preserve liquidity? Does it defend purchasing power? Does it own pricing power? Does it provide insurance? Does it expose you to real productive assets? Or does it simply rely on optimism staying generous? That last category is where the danger usually hides. Some positions are not investments. They are mood. Mood has done very well in easy periods. Mood does badly when the machine gets tight. Once you classify honestly, action becomes easier. Trim the weakest, reduce the most crowded, strengthen the reserve, build the businesses that can reprice reality, add insurance where appropriate, hold enough flexibility that fear from others becomes your opportunity rather than your contagion. If the worst never comes, you will still own a sensible portfolio. If serious stress does come, you will be one of the few people with both capital and composure. That is worth an enormous amount. People often ask what wealth is. At my age, I have a simple answer. Wealth is choices. It is the ability to say no. It is the ability to wait. It is the ability to help your family without asking a weak market for permission. It is the ability to live according to your own timetable, rather than the market's timetable. That is what a resilient portfolio protects, not just dollars choices. So if I believed the next chapter would be defined by abundant liquidity, cheap capital, easy refinancing, and effortless rescue, I would not be talking to you this way. But I do not believe that. I believe this is the kind of period that rewards arithmetic over story, structure over excitement, resilience over bravado, and liquidity over ego. That is why I would rebuild now rather than later. Not because I enjoy caution for its own sake, because I enjoy freedom, and freedom is much easier to preserve than it is to rebuild after you gave it away to a market that looked calm right up until it stopped being calm. If the strain grows from here, I want to own cash and near cash so I can move. I want to own businesses with pricing power so inflation does not quietly punish me. I want some insurance against monetary foolishness. I want some real assets tied to actual human need. I want modest hedges only where they serve discipline, not excitement. And when the panic finally creates the bargains that only panic can create, I want the temperament and the liquidity to act. That is not fear, that is preparation. And in the final analysis, preparation is the kindest thing an investor can do for his future self.